Here's your scorecard. 60 minutes to go in regulation. Markets on edge all session long. Stocks, as you know by now, gyrating quite a bit. Yields plunging. Questions swirling about the future path of the economy and the Fed, and whether its own policy is now altered in a major way. That, of course, is our talk of the tape today. We have a special guest to ask that question, too. Jeffrey Gundlach. He's the CEO of DoubleLine Capital. He joins us now in an exclusive interview. Desperate times call for desperate measures. Jeffrey, I appreciate you being with us.
Well, thanks, Scott. It's good to be here.
Yep. What is your reaction to all this?
Well, I've been thinking a lot over the past year or so about a quote from Mark Twain, which I'll paraphrase. It ain't what you don't know that gets you into trouble. It's what you think you know for sure that just ain't so. And why I'm bringing this up is it occurs to me that all of us, even old geezers like me, who've been in the business for over 40 years, have experienced nothing but gradually, systematically declining interest rates. So interest rates 40 years ago, it was the early 80s, and we had Volcker come around and slay the inflation dragon, and interest rates started to fall. I remember when I started in this business and people thought a few years into my career that when rates got to 10%, they thought they were low. And then when they got to 8%, they thought they were low, even though the inflation rate was at 4% and falling. And so what I'm getting at here, Judge, is we all think that we know things based upon our experience, and we try to extrapolate them to help us navigate the future. But all that we've experienced, even an old guy like me, for 40 years has been either relatively stable or declining interest rates. And so now that template I've been thinking about might not be that valuable in helping to navigate what's going on now that interest rates are rising very rapidly, as they've done over the past year. And I've been thinking that, maybe that this interest rate rise that hasn't really occurred for most people's career kind of blindsided people into thinking, hey, here are these treasuries that are down. There was a moment when the 30-year treasury bond from its peak to its trough was down 50%. And until about a week ago, it was still down in the 40%. And whenever you have a very large asset class, particularly one that's viewed to be safe and is even compelled, institutions are compelled to own due to regulation dropping that much, it's only sensible to think that there's going to be some sort of fallout. So this is a very important theme. I think a lot of the things that we've come to think that we know just ain't so when it comes to rising interest rates. And obviously that's the case with this regional bank crisis. And I suspect it's also going to be the case for credit, particularly very far down the capital structure in credit, like the lowest tier junk bonds and bank loans, where everybody thinks they know what the default cycle looks like and how it develops. But that was only due to falling interest rates. Now that interest rates are much higher, maybe it's going to be more difficult for bonds to be rolled over at higher interest rate levels. I mean, has a high yield bond ever really matured? Aren't they all just default or refinance because there's stable and a step function lower in interest rates, and so companies over and over again got the ability to refinance, but they can't refinance now. So one thing that I'm thinking about in the markets is that with this sharp rise in short-term interest rates and obvious stresses developing in the system, we should probably be very nervous about the lowest tiers of floating rate debt, like CCC rated bank loans, which we're having to pay about, 8 or 9, 6 or 8%, and now it's more like 10 or 12% with interest rates higher. So one thing that is curious about the last few days is the speed and I would say abandon with which the response came. I mean, it took forever back in the global financial crisis for people to change the rules and say that, okay, it's okay to default on mortgages and this type of thing, even though it's against the prospectus of the securities and so forth. Here, we've already got this amazing situation where the Fed is accepting bonds that are worth 70, 80, 60, 55 cents on the dollar, and they're accepting them against loans at par. So the rapidity of the response is impressive, I guess. But also, it suggests an inflationary outcome. The Fed doesn't have any money. The Fed is losing money. Dick Beauvais was on CNBC Asia yesterday, late in the afternoon, talking about how the Fed's net worth, if you actually mark them to market, is negative $1.1 million. So the only way to actually backstop securities that are worth, 70 cents on the dollar and loan 100 cents on the dollar against them is to print money. And so this is why I think that we have the yield curve movement that we have today, where the long bond is at this moment up in price less than the 2-year treasury. So the yield curve is steepening tremendously, de-inverting is what I should actually call it, which is really the last signpost that the recession is coming sooner rather than later. So I'll stop there, Scott.
This has moved up, Jeffrey, your recession timeline, it sounds like?
I think it has to, because this is one of the things that I use indicators that are, again, maybe I think I know something that I don't know because I'm using the past again. But I do think that one of the indicators that had not been signaling recession was the yield curve was getting steeper and steeper. And in all the past recessions, going back for decades, the yield curve starts de-inverting a few months before the recession comes. And so since we were at peak inversion last week, it was unlikely that we were going to go into recession even in the next 4 to 6 months. But at this point, with the de-inversion happening, the 4 to 6 month time window is starting to seem much more plausible.
This event, people have been saying all day long, and it's sort of obvious, has to be massively disinflationary. Now that you have all of this concern in the market, you don't think so? Well, first answer that question, then I'll ask you about what the Fed does from here.
I think that the inflationary policy is back in play, with the Federal Reserve obviously, putting money into the system through this lending program. And so this resolution that Jay Powell has been adamant about since last August or September is no longer really in play. So yeah, it could be disinflationary in the near term, but it seems to me that the response is one of instant backstopping. And to the extent that banks, regional banks, have further pressure, which may or may not be the case thanks to this action, but if it is the case, there's just going to be more inflation. So I think that this is an inflationary policy. It might be good for risk assets in the near term, because risk assets love inflationary policy and expansion of the Fed's balance sheet, which has been out of the room for quite a long time. But what's interesting is stocks are doing well today. What's not doing well are junk bonds, which are down in price, bank loans, which are down in price. Emerging market debt is basically unchanged. Even corporate bonds in the investment grade category are lagging, or were lagging fairly substantially. Treasuries have started to give back some of their gains. So I believe that this is really throwing a wrench into Jay Powell's game plan, because as you opened the segment, desperate times, desperate measures, and so you just kind of throw everything away. And I think the inflation fight is temporarily being abandoned. So the economy might have less demand, but the policies that are in response to this crisis are inflationary policies.
When you say the inflation fight is, quote, being temporarily abandoned, what does that mean you're suggesting about their policy moving forward? What happens on the 22nd of March and beyond?
Well, I think the Fed at this point will probably raise just 25 basis points. Yeah, I would say at this point, the chance, things are happening so quickly that even though it's a week away, a little over a week away, anything can sort of happen. But things are happening so quickly. I just think that at this point, the Fed is not going to go 50. I would think 25, and I know that people are wondering if they're going to go up at all. I just think to save kind of the program and their credibility, they'll probably raise rates 25 basis points. I would think that would be the last.
Really?
The last increase, yes.
I'm surprised to hear you say that. I would think that, this has caused such an earthquake, or certainly some pretty serious tremors, that they might not do anything in March. But you actually think they still would go in the name of their own credibility?
I do. I do think so. We'll see what the inflation numbers come out this week. I mean, who knows if they're really that relevant in the context of this banking crisis. But I do think I think the Fed will raise rates 25. I do. I wouldn't do it myself. But what do you do in the context of all this messaging that has happened over the past 6 months? And then something happens that you think you've solved, or I think the administration thinks they've solved it. And although it's a sleight of hand, it's like sort of a magic trick to accept bonds at par that are worth 70 cents on the dollar. But I think it has clearly calmed the waters. But the Fed, I think, will raise rates 25 basis points. It's just, I think in the market pricing, I think it's kind of a coin flip right now.
Wow, because I mean, you know, when you see what's happened with, let's say, the 2-year yield, which is, gosh, it was down 100 basis points over 3 or 4 sessions. You've always maintained the case that the Fed follows the 2-year. The suggestion that, Jeffrey, that the Fed chair left us with last week was higher, faster, for longer. It seems to be on the precipice right now, no?
Right. I mean, let me put it this way. It'll be proof positive that the Fed follows the 2-year if they don't raise interest rates. Proof positive. Because as you just said correctly, Judge, 1 week ago, 1 short week ago, it was higher, longer, you know, more than before, and all this other stuff. And then a few days later, what they're going to go to no hike. Then they're simply, absolutely, positively, if the Fed doesn't raise rates next week, we should absolutely shutter the Fed and just use the 2-year, which I've been saying facetiously for quite some time. But at this point, it would just be blatantly obvious that they're following the 2-year if they don't raise rates. Because
I mean, maybe they're just reading the room. Why wouldn't they just be reading the room and reacting to, if they're so data dependent? I mean, what's a more credible piece of data than a bank or 2 banks collapsing? That's not an economic report but you know.
The room is the 2-year Treasury yield. That's what the room is. If you're reading the room, you're reading the 2-year Treasury yield. And so they would not raise interest rates based upon the 2-year Treasury yield. And yet, again, it's so fascinating that officials didn't see this coming. I mean, we've had a huge repricing of one of the biggest markets in the world, the U.S. Treasury market. And whenever you have a huge repricing of something, somebody's out there swimming without a bathing suit. And I'm not saying that Silicon Valley Bank did anything particularly wrong. They did the classic thing. They were borrowing short and buying long-term fixed-rate securities, which, by the way, is exactly what the Fed's been doing. And that's why what Dick Beauvais is saying is correct, that they own all of these treasuries that are massively underwater. They did in quantitative easing. So the Fed doesn't have any money. So the only response to crises right now is printing money. And that's why I think we have a steepening yield curve, or a de-inverting yield curve, and we don't have the long bond going up even as much as the 2-year today.
You mentioned one of these so-called carry trades, I suppose. Marko Kolanovic of JP Morgan sent out the following note just before you came on, and I want your reaction to it. He says, quote, "There are many carry trades that they can't all be bailed out. When the economy is slowing down and financing costs are rising, all these implicit or explicit carry trades are pressured to unwind, leading to an end of the cycle. We believe we are in that stage and remain negatively positioned on risky asset classes. As such, we maintain a defensive tilt in our model portfolio, further increase our underweight to equities versus raising our cash allocation." What's your reaction to that comment?
I think he's onto something when he says you can't bail out every carry trade. And we've gone through so many bailouts in response to every recession. And the last one, we had to bail out the entire banking system. And this time, we might have to bail out the Federal Reserve. We have to run an inflationary policy when we have the need for the counter cyclical stimuluses, and yet we don't have any money. This is really this growing problem, the ultimate problem I've been talking about, Scott, as you know, sometimes in the corners of the room, but sometimes in the center of the room. We have 700% of GDP in unfunded liabilities. We cannot pay them back in today's dollars. It's simple arithmetic. And the Social Security system trustees say they're going to run out of money in 9 years under the assumption of no recession for the next 9 years. They're going to run out of money before then. We're going to have to deal with these problems. And unfortunately, the easy way to do it politically is to run more inflationary policies, to never allow defaults. So I agree with the sentiment, particularly in that note, that you should be avoiding the lower tiers of credit, particularly floating rate credit, like the plague. This is a really, really problematic situation where we have CCC rated bank loans yielding 19.7% to maturity, assuming no defaults. Obviously, the market is telegraphing very substantial defaults in those securities. And the lending standards being tightened over the past year is a precursor to higher default rates, particularly when this recession, which now appears to be almost guaranteed to occur in 2023, really starts to gain momentum. So
before
I
let you, I'm sorry. Before I let you run, I mean, in your own mind, the investing playbook, has it changed somewhat given the events of the weekend, the move that we've seen in yields? I can't tell you the number of people who've come on the network over the last many months and said, yeah, short-term treasuries, great trade. Bonds are so cheap, generational opportunity. I'm wondering what you think today.
I have not changed my game plan because it's working very, very well. I've been advocating for quite some time a barbell of long-term treasuries, 10 years and longer, to offset the credit risk that one takes to get yield. And that's working very well because the treasuries are playing their role. And credit is not really collapsing, but it's definitely stumbling. And I think that as the recession comes, we'll see greater tiering in credit. So I think that my game plan hasn't really changed. I've been moving up in credit for the past 18 months systematically and increasing treasuries, particularly at the long end. And I've been sleeping very soundly these last several nights, even though there's a lot of anxiety in the air, because this barbell portfolio with middle tier credit and long-term treasuries is the recipe to survive comfortably the situation.
I'm going to make that the last word. I told you I was going to take 15 minutes of your time. I've taken a few more, and I hope you'll forgive me for that. But we'll see you soon.
No problem. Be well, Scott.